You need to look to be profitable in the good year, maintain your costs and retain that structure going into the good year. And all that means is your profits will bounce faster, your peaks will be higher because your cost structure is lower, and then you'll have more this rainy day fund or a bit of cash left over that you will be able to have it for as the milk price comes down.
As 2025 draws to a close, it will be remembered as one of the best farming years in recent memory, due to strong milk prices, improvements in stock values, and good weather for most parts. Although it has to be said, milk prices have seen a significant reductions, and attention is now turning to how farmers can best prepare for next year. Joining me today is Teagasc Dairy Specialist Patrick Gowing to discuss how to best manage surplus cash, build financial resilience, review production costs, and ensure farmers are best prepared for 2026. Thanks for joining us, Pat.
No problem, James.
We spoke about 12 months ago, and the outlook obviously at the time was extremely positive. It was very much a rising milk market. How has that transpired over the past 12 months?
Look, last year it was good. Milk markets were good, as you say. We would have looked at figures back after the profit monitor run in the spring, and we would have predicted forward, that 2025 was going to be a good year, probably the second best year after 22. And that was aided by, generally speaking, around the country, I'd say, good weather. I know there's some people who were dry and had to feed, and the west got a bit wet there at times, but one with the other was a good grass growing year. And then the value of stock increased as well. So, yeah, they had a good run, and that's coming on the back of the second half of 24 was good. So 24 ended up being a slightly above average year. We're into a strong year in 2022. Won't be probably as strong, strong year in 25. It probably won't be as strong in 2022 as 2022. It'll be a little bit back, but you are looking at, on average, the profits of 25 being probably over €1,500 a cow, where there would have been 1,800 in 22. So yeah, good year all around. So it worked out unusually as we predicted.
Yeah, and I suppose look at that should ensure that there is cash surpluses on farms as we head into autumn winter of 2025, obviously.
Yes, there should be, and look, it can be hard to quantify it, and we wouldn't really see it, or you can talk to farmers going around the place. With discussions with banks, and again, it's just in a general term, they would say, or it seemed to be, that the state of the current accounts are quite good, quite strong on average. So I think we're, because of the better weather year, and I'd say sort of a year and a half decent, that things are not too bad. But again, we've discussed it before, and we'll probably get into it a bit later again. But averages can be deceiving, James. Some people had a very, very good year. Some people had an average year, and some people a below average year. And it's the average might be hiding for some people mightn't have just realised the full value of the milk price for whatever reason, and that could be the issue as we look forward as well.
And maybe as we look ahead forward to 2026, as you mentioned a minute ago, the opposite probably is true. Milk prices have dipped in recent months with increased supply and weaker demand on world markets. The real impact of this probably won't be felt until next spring, though, in the main, Pat, due to the higher solids at this time of year. Is that fair?
Yeah, it's as our constituents go up, generally the up to now, albeit some of the drops there this week are quite heavy. The value of your solids would keep the price static rather than dropping, and as we get into fresh milk in the spring, you won't have the cushion of the higher constituents, so you'll see a significant change in your price. I think you're right. I was looking back there, knowing that I was going talking to you today, and it's the way the thing changed, I suppose, caught people off guard. I was looking at articles that were wrote in August, and there'll be a bit of a softening, and things will be going to be reasonable in the medium short term on milk price. There was nothing to upset the apple cart. I know myself, I got caught on the hop as well. I wouldn't claim to be a market analyst or anything like that, but this is the first day of the plough match, and the announcement that the milk price was dropping and further was to come, and probably caught a lot of people on the hop at that stage. And again, to the extent that that's going to go. So it looks, as I say, there's an oversupply. Seems to be some stocks, particularly in butter and cheese, that have been hit the hardest. And if a co-op had a stock of that, or more exposed with their product mix, it's after hitting them hard now as the market readjusts with the oversupply. So yeah, we haven't seen it yet, but it's going to be there in the spring.
You mentioned 2022 obviously being a historic year in terms of good farm margins, but subsequently 2023 was turned out to be quite a difficult year in terms of a drop off in milk prices, and that hit profits at farm level. I suppose, what are the key lessons maybe farmers should take from that experience?
Yeah, I think, and I know I've said it to a group or two. In one sense, we're pre-armed and pre-warned. I suppose we have to look at that. You look at it from a 6 month point of view, James, and you also have to look at it what's happened over the last number of years. And I suppose, we'll get onto it a bit later too. Like, but the biggest thing that we're noticing is the cost structure is higher, and we all know why and things like that. And there's a range within that as well, which we can discuss later. But the fluctuations in milk prices now in a relatively short space of time are massive. Like, so if we look at, say, from 2022 to 2023, the average price received in 22 was 61.3 and it dropped to 44.4 back into 23. So you're talking about a significant drop off. That's 15 cent a litre or thereabouts, and that directly correlated with the drop in profitability in that year. You could just, because there was no adjustment on costs, so whatever the milk price dropped, a similar thing happened within your profitability off the top of the year. Now we're unlucky in 23. There was a sort of particularly the second half. It was a wet year as well that didn't help. So what we learned from before is that our cost structure has remained stubbornly high, and we're moving through this massive fluctuations in milk price. And I think it's important to note that this trend has been there over the last 10 years. And if we look at the years from 14 to 19, you get this swing of milk price as well. Like, so in 2014, it was 39 cent, it dropped to 31 cent, and then down to 28, and then back up to 37. So we're getting them swings in milk price, but probably maybe more over an 18-month period rather than a 6 month period, and probably not to the same extent that we are now. So when it goes up, it's good. When it comes down, it comes down fairly fast. So that, is it a trend? Is that what the cycle we're going to see going forward? But we're sort of after going through two boom and busts, if you want to call it. And I think we have to look at that going forward to set our businesses up that it's all right in the good year, but can we take the low year as well?
You hear that word, we'll say resilience, and our systems need to be resilient. But I suppose, how can farmers practically kind of build more resilience into their own farming systems?
Yeah, so again, and if we go back, and this is all profit monitor data, and I'd say we've done a podcast on it before, and it's the same thing relived again. And we look at the first thing about 2023, the average profitability in 2023 was about €623. Again, we had this massive range from 40 to 1140. So it's where you are on that average is the point. Like, and you have to look at, if you're in 23, people made reasonable margin and some people didn't. And look, there's always case by case scenarios, and there's reasons in some farms, and there's some places there's just a bit of bad luck. But if you're trending an average that you're below the average, you have to look at what's going on. And the biggest thing that we saw when we went in and look at the figures and just compare the margins of the higher profit farmers and the lower profit farmers, was cost control. And I think, and I'd say I maybe swept up along a bit into everyone's got the ear and it's costing more money, and what can we do about it? But when I look back into it, I was surprised. So in my mind, sure, most farmers are vaccinating for most things. Sure, everyone has to make silage. Can't be that they'll have a slight price variation from region to region. But when we went back into it, there was massive variance in the cost of the on from farm to farm, and in every category. And it wasn't actually the feed and fert, which we normally look at. It was ESB, it was veterinary, it was AI, it was contractor, it was the balance of costs, as we call it. So you have a high contractor cost and a high machinery cost. It doesn't always match up. And we just seem to go offside on some costs, and we need to get back to basics and control it. So half the differential in profit in the poor year came from cost control. Now, the other thing I'd just like to say on that, James, it's a third of or 35, 36% in a good year. So if you go back to 24, which is a good year, 35% of the differential came in cost control. So I don't think we can turn it on and turn it off, because we turn it on all right.
Yeah, and that feeling probably did creep in, Pat, and the fact that look at, costs did obviously increase significantly from 21 into 22, and unfortunately have remained pretty stubborn over the period since. But we probably were guilty across farms of sort of saying that exactly as you said. Look, we're in a high cost period and there's not a lot we can do. But when you look at that data, it's explaining a big proportion of the variation in high and low margin farms.
Yeah, and to help that, last year we launched the bill of quantities, and look, you could argue we're a year too early with it because look, we're coming into a good year, and maybe think it was just sailing along, but like that's going to be a very useful tool into this back end. We have to just examine every cost, and we're not saying that you want to get back to 20 cent a litre cost or anything like that, but for every cent you save, it's a cent saved. And try to lock that in and keep it right for the good years as well. I think that's where we're going wrong. We're we're not able to handle the yo-yo effect of the milk price. We in a good year we may maybe drive to get the extra price, which is a natural thing. I don't think it's a normal thing. Milk price is good, and you say we're going to go after it, and that's fine. But we'd have to be ruthless on the way back down. So basically, if you chase something in the good year, you'd have to undo it in the bad year. And what I that's what you'd have to do in this cycle. And what I would see is generally from farm to farm, we're not fast enough, or don't realize maybe it's going to happen as bad, or maybe there's a bit of hope in it as well, that we get there and we stay there and try to ride it out. Where I'd be sort of saying you need to look to be profitable in the good year, maintain your costs and retain that structure going into the good year. And all that means is your profits will bounce faster, your peaks will be higher because your cost structure is lower, and then you'll have more this rainy day fund or the bit of cash left over that you will be able to have it for as the milk price comes down. So this chasing is good as long as you don't chase on the way down, and we're not doing that. I do think there, James, too, some people are probably in a stage that maybe if they go look at the cost, they might have overly sunk a lot of costs in or something. Like there might be, maybe it's a little bit overstocked or something, or whatever it is. Like they could unwind it and get back with small adjustments. Other people are potentially looking at different type systems and things like that, maybe more of a driven type system. And all I'd say is if your costs are going over that average that we would use at 37 cent a litre, you have to look at. And to me, if you're setting yourself up at a higher cost business, you're taking a punt on the milk price, and that's a hard place to be.
Mm-hmm. And you mentioned it there. I might just come back to the costs in a moment, but it's even knowing your costs, Pat, and I often hear you or see and hear you say in terms of know your costs. You're talking about identifying costs, but I suppose, where does a farmer maybe start in assessing their own costs? Like there's maybe not enough farmers doing that kind of detailed benchmarking analysis. Is that a fair statement?
Yeah, look, you have to benchmark. You have to know your costs. And I'm 20 years in Teagasc. I've been saying it for 20 years. So maybe we should say it a different way, maybe, or something. But every other business benchmarks. That's the way I always start, and I trained up at the start. Everyone else knows their cost of production. Why don't you? I think we could probably, during the quota period, and even the period after quota, it was a relatively stable period. Like, things were generally okay. Now we're just getting into this massive volatility. So it's more important now to do benchmark than it was back then, because the thing is changing so much. And there's also a lot of question marks and things around regulations and all that. Like, what's the best way to go? Know your costs. And if you are making changes on your business, know where your costs will be when the changes are made. And that's another important point, like, because if you are looking at doing something maybe a bit different, that's fine. Maybe that's the way you want to go. But if that's pushing you into a higher cost business, is that the place over a rolling 5-10 year average to be in? Because if you look at the last 5 years, we've had 3 very good years, but we're going to, like, so that's in 20 to 25, 20 to 21 to 26, when 26 comes in, if assuming depending where milk price goes, you'd probably have 3 very good years, but you're also having 2 bad years. So on average, then it's fairly average. So we just want, that's the trend that's there at the moment. And look, profit monitor is the obvious one, James. There's your accountant may be able to do it. You may have a financial advisor. it doesn't matter once you have it done. It's done right. And the last thing, and you'd see this too, it's done for yourself. You shouldn't be doing benchmarking figures to suit someone else. This is for your farm to make sure you're on the right path. So do it right, get it done. And last thing is the same as grass budgeting, James, and you've often heard you at it. If you generate the data, use the data. And that's what I'd say. So this is the year to do it.
That's where, and you often see, and I've seen in the past in terms of where we headed into periods, Pat, with lower milk prices, where people start talking about cutting out costs, and one that just pops up in my mind is the likes of, milk recording. You're not talking here about not spending on the fundamentals, and the likes of milk recording as an example would be one of those. You're really looking at individual costs, and is there an overspend, I suppose, in certain areas without cutting out spend on the fundamentals to run your business and deliver good performance?
Yeah, 100%, James. Like, so you have to protect your business. You have to, and again, your business has to be there for the upturn as well. So the fundamentals that deliver need to be kept in place to deliver for the good year as well. Like, so and I would have seen that when back, I was working up the west at the time, and if you go back to the period of 08, 09 and the weather was bad, the milk price was poor. And probably there maybe when there's the enthusiasm around dairying as there is at the moment, like that some of the farmers have probably stopped investing in their farms because the weather was poor, and maybe we're looking at the economy was going well, or maybe looking at other options. Like, but the big thing to me, when the weather went very bad and the milk price dropped, when the thing came up, the farm wasn't able to generate enough grass. It was slow to get going because it was under pressure because the investment hadn't gone into it. See, like, there's some things that are fundamental, like obviously your grass, and we'll get back onto in a second. Your soil fertility, your cows, they have to be done and done right. But when we go back and look at all the costs again, is some people are using more of any item than another, or could be simple thing as vet call-outs or something like that. Like, there was substantially more vet call-outs going into one farm than in another farm. And again, there could be a reason for that. If it's a good reason, it's a good reason. Things go wrong. But if it's consistently there every year, you have to go in and look at and fix it, because what's going to change? Similarly, an all cost, ESB is another one. Like, so it was tipping along grand, spiked up because of the Ukraine war, dropped back down, slightly moving up again, just doing the big switch. Some people paying too much for ESB. So it was simple things really that were starting to add up. And if you do that in every category, you find the savings. But we weren't saying not going to AI the cows this year because it's a bad year, because that was going to affect us later on. In fairness, there was a good lot of receiving done this year, which will help us in the other years. Like, there's places where you can put your money that are a good return, and there's places where you can put your money that wouldn't be so good.
Maybe, and we move off the cost piece in a moment, but I suppose each farm situation will differ. But as you say, it's important a farmer knows the difference in terms of where their variable and fixed costs are at. But maybe then the next steps for some farmers really will be known where the total farm cost of production is at. Like, when you add in drawings, capital repayments, taxation is included. Like, I spoke with a discussion group recently, and when we calculated this figure out, Pat, I suppose it comes as a surprise as a lot of farmers.
Yeah, the full cash cost of the business. Yeah, we'd also call that break-even analysis. So, and look, we can do that. I do. Some groups and some farmers will just put on a figure for drawings and things like that. I don't like it. Again, your benchmark figures of yourself, and putting down a figure for a group purpose that you need 30,000 to live and you actually need 60. Sure, what's the point of it all? Your business still has to deliver it. So that break-even analysis will catch that, and not just to tell you the base, when you work it back down, the fundamentals, that will tell you the base price the co-op needs to pay for you to deliver all, to basically cover all costs, including tax and drawings on your farm and principal repayments. And it's a good analysis to do. And again, it's individual, farm to farm, and it's also vary from year to year. So you have to keep after it, but it gives a good line up where your business is going and what needs to be done. Like, so it can be coupled with a lot of data is taken off the profit monitor to do it, but like, these are the type of tools we need to know where we are, and then making sure we're on the right road. So yeah, get your costs, look at them, and react, and use that bill of quantities. And the bill of quantities is basically, and Pádraig O'Connor's done a lot of work on it, is that it's the exact units of each item. So it's number of vet callouts, number of gloves you have to buy. It's the amount of stuff that you need to run a farm properly. And as you said, it's not going to impact on your overall farm profitability. So it's like a shopping list for the year. And all we'd say is if you're high cost and one cost, go in and look, compare it against the bill of quantities, identify the area you're wrong. If you can justify that spend and you're getting a return on it, fair enough. If you can't, move it on.
You mentioned working capital, cash flow, working capital, that whole space. I've heard you before advising, having working capital, obviously a cash reserve or rainy day fund, even there you said earlier. Is there a target figure the farmers should have on hand at the end of the year?
It'll be massively variable between farms, depending on what age the kids are, debt levels, tax, companies and all this type thing comes into it. But we model that out through, and it comes in around there. So the difference between the 350 and the 150 is fundamentally coming from an increase in drawings, an assumption on around drawings, and it's also coming from your feed and fertilizer and your input costs, albeit they're not as high as they would have been in 2022. They're tracking up a little bit, and other costs are a little bit higher. So your initial spring part of the year is sort of, you don't supply as much milk, so the milk price doesn't overly impact it, but you also import. It's a sort of a 60-40. You get 40% of your milk check and you get 60% of your costs. So as the costs increase, it'll just pushes more pressure on working capital requirements. And then again, it's coupled with the house, and then it takes the milk price. The difference is to start, and as the volume increases, starting to correct for that as you go. As the milk price obviously drops, the checks don't go as far, and that brings, you combine all to get them together, and you get that sort of €500 a cow target. So if you have 100 cows, we would like that you'd have a minimum of 50,000 in working capital available to get you through the spring.
Yeah. Another thing you mentioned earlier, and it feeds into this conversation, and farmers maybe like to do too much out of cash flow, Pat. Investments and investment decisions, like many farmers will have plans for investments, obviously, after a good year in 2025. Your advice there maybe on balancing investment with maintaining cash flow?
Yeah, I think that's that figure, that €500 cow. Yeah, and look, potentially that's in the business at all times. That's what I would say. And obviously, if you could put a bit more with it, it'd be great. But like, that's you'll need that money. So you'll basically, if you had that 500 at the start, if €500 in your bank account on the 1st of January, by the 1st of May, it'd be more or less all gone. But then the milk checks would start coming through, and you'd rebalance it at the end of the year. So that's, if you're going to do an investment out of cash flow and you're dropping below that, you're exposing your farm. So it's the what ifs then start kicking in. What if there's a bad spring, TB outbreaks, something goes wrong with the machine, whatever it is, doesn't make a difference. Things go wrong. Then you're strapped for cash in a bad milk price year, and that can put a lot of pressure and stress on farmers. So try to avoid that. So that's if you're dipping into that and you're leaving yourself tight next spring, you would question that. Then you have to look at the investment and say, well, right, do I need this investment? Is it going to make the place a better place? And I'm slow, James, to sort of say don't invest anything. I think the problem is we invest in the good year, the milk checks are good and come and go, and we invest in it. If you regret the investment in the bad year, then I probably shouldn't have invested in it. So is this going to leave your farm in a better place in the bad years? So sometimes you invest. There are some people, getting things cleaned, their cubicles and all that, and be labour saving, or building soil fertility, doing reseeding. Like, they're all, you can justify them. Might be the dearest thing you can bring in, bring out. That slurry storage, so you have to plan that a bit and move through with the grants and all that, but it'll stand to you, and you get a reasonable return on it. One with the other. Again, if you're doing them longer term structures, like we saying, borrow for them. Why put the farm under cash stress when you know there's going to be a pinch point there?
That's the
It's
key
easy.
point there, Pat, isn't it? Really, you're not saying that the investment, if it's the right investment for the farm, you're not saying not to do it, but it's to go and get finance and put that out over an appropriate period of time, really, rather than leaving
Yeah, yeah,
yourself
yeah.
short that come April, May, that you're under pressure from a cash flow perspective.
Yeah, so we don't know the extent or how long and the milk price will be low. We probably are not at the bottom of it yet, and how long we're going to be there. So the hope is always there that what goes down fast comes up fast, and that's the normal trend. But what if it doesn't? Or again, if you go back to 23, 24, you sure all you'd hear is sure it has to stop raining this week. I didn't. So you have to build in that buffer that things don't always go to plan. So yeah, if you're structuring it, if it's needed and it's structuring, it's the right investment for your farm, structure it out. You can pay it back quicker if you have 2 or 3 good years in a row if you want to. But don't put yourself under pressure in the bad year.
One thing I will ask, and some of our listeners may be saying 500 euros a cow, 50,000 per 100 cows, as you said, it's not there on the 1st of January. So what would you say maybe to those farmers that may anticipate maybe a bit of financial pressure coming, or, what should they be looking at, or what should they be doing, or is there things that should be putting in place early on, maybe to overcome some of those issues?
Yeah, so a lot of farmers have done capex, capital investment out of cash flow, so you can retrospectively finance it. If you thought you're going tight, you could go back into the banks and say, look, I did a calf shed or whatever you did, 30, 40,000 out of a cash flow. Think it might be a bit tight in the spring, and they'll capitalize that out basically. So take a loan on that, and 10, 50, 10 years. There's good loan options there, unsecured loan options there, with reasonable interest rates that are very suitable for that type of thing. And you can do it. So that's just it's basically injecting your own cash back into the business, because you're after doing a long-term investment, and you paid for it in 1 year. We're going to use it for 30, so you're just spreading the cost of it out over a number of years is all you're at. The biggest mistake that's made, and it's a natural thing too, James, and you don't want to be giving out the whole time, I suppose, but farmers, we get into it and you're busy in the spring and things are going on and whatever, and it's hard to get the feel of it, if you know what I mean, like, because there's milk starts coming, there's calves going out, maybe a few cull cows, and there's bills coming in. You have to spread the silage manure, and there's contractors, and it can be hard to sort of keep on top of it. And you might start running up merchant debt or credit, or a bit of overdraft or whatever it is, and it can be hard if you go too far down that road. It can be hard. It can be a slow burn to get out of it, and it basically would mean if you model that out, you could be strapped for cash for the full year, and then you're very dependent on the next year being a better year to sort of reset the books. Like, so and most farmers will get through it. Most farmers will survive it. There's no hassle. It's more the stress and the pressure it puts on them. It's just nice to have it all balanced and worked out beforehand. So that's the one thing you look at. I think you're very worried about, James. You do a cash flow budget. Again, with your Teagasc advisor, financial controller, model it out. And maybe it's not as bad as you think, or maybe it's a little bit worse. But sure, why not go for the reasonable quiet time of year?
That acting early, and I've heard you saying that before, where you do envisage maybe being tight, just get in, do something early about it. You're ahead of the problem as such, isn't it?
Yeah. Look, at the banks would always say that. Come talk to us early. I would say come talk to your accountant, if or your Teagasc or whoever, early as well, because the further you go down that sort of credit hole, if you want to call it, the harder it is to rectify it. If something goes wrong, or maybe if a check bounced or something like that, they all go against you from a borrowing capacity point of view. So if you're ahead of it, it can make a big thing. And some people would say, like, Jesus, like, if I go to borrow something again, the bank will hold it against me. And I'd say no. Banks actually prefer it. It shows you've cash flow discipline, that you saw a problem and you got in ahead of it. That actually shows good business head on you, rather than going down a rabbit hole, if you like, the other way. That shows that you didn't have control of your business. So there's no negative to it, in my eyes. Look, and again, if you have and it'd be individual, and you do your cash flow budget, and maybe the 500 is a bit high for your farm, it could be 400 or whatever, and you have it and you're safe, then you don't have to do anything. That's grand, off you go. Like, you know, so but it's just about being pre-warned beforehand. As we said, we got a taster in 23. What's overly different on your farm today than it was in 2023? So if you struggle in 2023, you know, you've been pre-warned now, so get ahead of it.
A lot of what we've spoken about, and it maybe might seem a little bit negative, but it's to have the conversation, I suppose, and even ourselves, along with our listeners, being ahead of it. But is there positives? I want to end on a positive note, Pat. You're always very, very positive. Is there positives we can kind of take as we head into 2026?
Well, there's a couple of things, I suppose. And again, if I look, we have an internal website here in Teagasc, and there's a crisis every 3 years. We're all back talking to each other the year after the crisis. So farmers are very reactive and generally can survive and move with their feet. So that's good. So as long as I'm at it, we love an old crisis every now and then. So we usually get over it. The other thing we probably didn't overly touch on it is we have to get focused back on this net pasture per cow, or maximize the cheapest feed on your farm that you have. And this is a positive for me now going into next year, because generally speaking, the back end of this year, the grazing conditions have been excellent. The clean outs have been excellent. The quality of grass that could be there next spring, assuming anyway sort of a decent run of the weather, will be exceptional. So we're far better set up from just even a ground conditions point of view than we were from 23 going into 24. Mentioned it as well there, that like there was a lot of, as far as I could see now, I don't have any official stats on it, there was a lot of reseeding done this year. I think that's going to stand to us next year as well. We probably didn't get, our rate of reseeding dropped in 23, 24. And I don't think that was actually a milk price thing. I think that was just a weather effect. So in fairness to the farmers, when they got the chance, they went and did it. So that's in place for the next year. And if we look at the costs and we look at the total costs, a quarter or a little bit more of the total costs on the average dairy farmer is purchased feed, whether coming from purchased concentrates, purchased silage, maize, whatever, it doesn't make a difference. It's about a quarter of your total costs. So unless we control that or manage that, we're going to be on the back foot anyway. And we have to maximize what's the cheapest, which is our own grazed grass and our own grown silage by high quality. I heard you with I'm not going to get back into all the parameters around grass management that you do with John Maher and things, but like next year's the year to do it. Refocus on that because we've been warned. And that was the other thing that came up from the 2023 analysis, was even the increase in stock value from 24 to 25 will be worth over 3 cents a litre. And now again, I don't like predicting beef prices and things like that, but it looked to be reasonably good for next year. So, you know, that'd be a little bit of extra cash, somewhere 3-ish cents a litre above sort of 2023, 2024 levels that will come, and most of that will come in the spring. So it'll help cushion us a small bit as well. So there's a few things there that are in our favour that'll leave us, I think, better set up than we were maybe post 2022. I think that was the first time we experienced it too in 2022. You know, the real high year followed by the drop off. So, as I say, we know we have a picture of what's going to come ahead of us.
Appreciate that, Pat. And look at folks, that's it for this week's episode of the Dairy Edge podcast. My thanks to Pat Gowing for joining me on this week's show. I suppose the key messages are clear. Know your costs, protect your cash flow. If you are looking at investments, are they the right investments for the farm, and are they needed? And act early, I suppose, if you do think challenges are going to arise. So for more information or support, contact your local Teagasc advisor. Don't forget to rate, review and subscribe to the podcast. You can listen on Apple, Spotify or wherever you get your podcasts. And for more information, go to the Teagasc website at teagasc.ie. I'm James Dunne, and join us next time for your Dairy Edge.